Hello, welcome to lecture 2 of module 6, where we are going to deal with the first step in the preparation of funds flow analysis, namely preparation of schedule of changes in working capital. In the previous lecture, we have deliberated upon the significance of changes in working capital within the purview of funds flow analysis. It is simply because of the fundamental orientation that whatever may be the business activity that gets executed during a particular financial year, it is going to influence any of the item of current asset or current liability which is there reflecting the short term orientation, or we may say the recurring orientation of a business organization. And we all know that when you are going to talk about working capital, it is nothing but the excess or net of current asset over and above the current liabilities to which a business is exposed to. When you are going to talk about working capital between two balance sheet dates, essentially there is every possibility that with the execution of different recurring or day-to-day business transactions, there may be some changes which are getting affected in the quantum of working capital which have been utilized during that particular financial year. So, it is imperative on the part of the users community to dig out what is the extent and magnitude of changes in working capital between two balance sheet dates, which is going to explore the short term changes in terms of utilization of funds in a business organization. In this lecture, we are going to make a deep dive into the modus of preparing the schedule of changes in working capital, the logics which are associated with working capital, and different items which are falling under the purview of current assets and current liabilities with the protocol of calculation of working capital, calculation of changes in working capital, and the impact of individual changes in current assets and current liabilities upon working capital. To start with, we are there to know what is the concept of working capital in detail. It refers to the floating or circulating capital used to meet the day-to-day recurring requirements and resources to meet the short-term obligations. When you are going to talk about short-term obligations, we are referring to the daily requirements of resources to comply with the business activities which are expected to be performed. For the execution of business activities on a daily basis, obviously we are going to have the resource or the capital on a circulation basis or on a floating basis, so that as and when there is any need of resource to execute business transaction, we should have that resources at our disposal. Working capital caters to that resource requirements which are going to be utilized in the business to perform different recurring activities on a daily basis, as well as to meet the short term obligations which are emanating during the operations of a business. Moving further, when you are going to talk about working capital, as I said, it is the excess of current asset over current liabilities to which the business is exposed to. Talking about the components of working capital, we are there to start with the current assets. Now, current assets accommodates inventory, which is reflecting all the forms of inventory, may it be in the form of raw material, may it be in the form of work in progress, may it be in the form of finished goods, may it be in any other form which are kept as stock and expected to be utilized in the business to perform different day-to-day transactions without any blockage or on a perpetual orientation. So, the prevalence of inventory is there in each and every business, whether we are going to talk about the manufacturing entities where the prevalence of inventory in different forms are more prominent, or we are talking about a trading business entity where the entity is procuring the finished product in one hand and keeping a stock of those finished products to facilitate the sales without any hiccup or interruption. Inventory is one of the fundamental component of current asset owing to the simple reason that it is converted into cells and subsequently the cash is going to be realized in the process of conversion of inventory into cells. So, it is directly falling under the purview of current asset, because we all know what current asset is. It simply represents all those assets which are possible to be converted into cash without any shrinkage in its value during a particular financial year. Inventory fits into that particular definition well, though there are qualitative differences between different current assets. We will be discussing the same later on. Then the second component is cash and bank balance. Obviously, cash and bank balance are maintained in the business to meet the immediate resource requirements in lieu of executing different transactions, may be related to expenses or any other aspect of business. So, it is inevitable on the part of each and every business entity to maintain and have some liquid resource in the form of cash or in the form of bank balance, which can be put into its immediate use as and when they are required in lieu of different business transactions. Then the third item is debtors. It is essentially the outcomes of credit sales activities of a business organization. We all know that in a customer driven corporate world, we have no choice but to accommodate the customers on a credit terms in order to magnify and maintain the sales which are expected to be achieved. We cannot dream of a business where only the sales are getting executed on cash basis. In each and every organization, there is the prevalence of both, that is cash sales as well as credit sales. So, whenever the company resorts to the act of credit sales, there emerge the debtors from whom the cash is going to be realized after the lapse of the credit period allowed to them. Then there comes bills receivable, which is closely resembling with that of debtor, with the only difference which are because of the prevalence of Sale of Goods Act, and as a result of the prevalence of Sale of Goods Act, with every credit sale activity, if a bill is generated against that, that becomes bills receivable, and that is going to be realized even at a faster rate and with more probability compared to debtors. Then there comes the next component, that is marketable securities or market securities, which are more or less short term instruments which are used by the business to reap the benefit of interest or in any other form without blocking their surplus cash with them in an idle state. So, all the companies are resorting to that particular task of investing in securities which are easily marketable. In a sense, they are easily possible to be converted into cash as and when there is the need for the same. Then in the same line, there comes short term investments. Also, it is the use of idle cash remaining with the business for a very short span of time, say for some months, and investing in those instruments which are going to have a maturity of 90 days or less than 90 days and can be easily converted into cash as and when the business is in need of cash. Then the last is prepaid expenses. It is a different class of current asset which are also complying to the characteristics of current asset indirectly, because when we are paying advance salary to a particular employee, we are there expecting to avail of the service of that employee without expending anything, because already we have paid the salary in advance. So here it is indirectly falling under the purview of current asset. Moving further, the other side of working capital is current liability. Now let us have a discussion on different components of current liabilities. To start with, the first one is creditor, which is the outcome of all the credit purchases that are executed by a company with regard to the purchase of raw material or the purchase of different supplies which are used in the business to perform day-to-day activities, but whatever they may be. Whenever we are resorting to, or any company is resorting to credit purchases, it is expected that the company is there to pay off the creditors within a short span of time, normally within one financial year, because the companies are in general availing of some months to repay to their creditors. So the first category of current liability represents the creditors who are very closely associated with the day-to-day states of affairs of a business organization. Then there comes the bills payable. It is again very closely resembling the creditors, with the difference that with every act of credit purchase, if a bill is generated, that would become bills payable, and the bills payable are expected to be squared off with the legitimate time mentioned at the time of execution of the transaction. So far as the company or the business organization is concerned, if there prevails bills payable, the level of urgency of payment is high compared to creditors, and the companies are expected to comply with those things in lieu of the contractual obligations which are there associated with a credit purchase. Then the next in the line is bank overdraft. Every company or business organization are availing of the overdraft facilities extended by banks to meet their immediate or short-term requirements. It is one of the arrangement between the company and the bank who is extending different banking services to the company, and obviously whatever may be the magnitude of bank overdraft created by a company, the companies are expected to repay the same within one financial year as a general arrangement between the company and the banker to the company. So again it is falling under the purview of current liabilities. Then there comes outstanding expenses. It represents all those expenses which have not been paid, but it is expected to be paid during the financial year, and hence it is also falling under the ambit of current liabilities. In same line, provisions for taxation. When you are going to talk about taxation and the provisions created by the business to meet that legal or the mandatory expenses, it is obvious that tax cannot be evaded, and at the same time it can neither be avoided. So it is the prerogative on the part of the company to meet that particular liability which is current in nature, owing to the simple reason that the tax when becomes due is required to be paid by the company well in time in order to avoid any legal complications. It is also falling under the purview of tax liabilities, and it is expected to be made within a particular financial year. Then there comes provision for bad and doubtful debt. It is simply the provisions created against the debtors, because when a company is resorting to credit sales activities, the company is expected to realize the proceeds out of credit sales activities, but there is no guarantee. Rather, we may say the element of uncertainty with respect to realization of proceeds from the credit customers is always there, irrespective of size, scale, sector or the economy where these transactions are getting executed. So, it is always imperative on the part of the business organization to safeguard their business from these unfavorable occurrences, specifically when a particular credit customer is unable to pay the amount owed to him due to any reason, whatever may be the reason. If the company is not realizing the proceeds from a credit customer, it is a direct loss to the company so far as revenue is concerned, and it is there to happen on and off because of the very nature of credit sales activities. So, as an act of prudence, it is always advisable on the part of the company to create sufficient provision for those debtors which are going to be doubtful or which may go bad. So, there prevails two different orientations. Some debtors are going to be bad, simply implying that the company will fail to realize money from them, and some are in the doubtful category. They are in a state of jittery, nobody knows what is going to happen. So, in the world of accounting, in the world of finance, there prevails receivable management, different techniques of receivable management, and all these things are in practice in the corporate world. But over and above that, it is always essential on the part of the company to create some provisions. That is also as because the provisions are created against debtor, which is a part and parcel of current asset, it is also against that, because when you are creating a provision, you are indirectly apprehending that that is going to be the short term or immediate liability. So, it is falling under the purview of current liability. Moving further, after having an elaborated discussion about different components of current assets and current liabilities, it is time to go for the calculation of working capital, which is simply the sum total of current asset minus sum total of current liabilities to arrive at working capital. But here I must make a mention of the fact that though we are not accommodating the time value of money, or though we are not differentiating between current assets and current liabilities within their own group, say for example current assets, we are treating all the current assets as identical. But if you are going to talk about the speed with which different components of current assets are expected to be converted into cash, there lies differences. The speed with which inventory gets converted into cash, the speed with which debtors are getting converted into cash, the speed with which bills receivables are getting converted into cash, the speed with which marketable securities are converted into cash or short-term investments are converted into cash, they are never going to be alike. There lies differences so far as the speed with which they are getting converted into cash. So, it is always advisable while calculating working capital, if it is feasible and possible at the end of the users community, to introduce a weighted orientation by calculating the frequency. of conversion of different current assets into cash, it would be better off so far as the decision making orientation is concerned at the end of the users community. Similarly, on the contrary, when you are going to talk about current liabilities, we are not differentiating while calculating working capital, but we can do so by introducing a logic which simply implies what is the level of urgency of repayment of different current liabilities during a particular financial year. The urgency with which creditors are to be repaid, the urgency with which bills payable are to be repaid, the urgency with which the bank overdraft is to be repaid are going to differ. Practically, when we are talking about the day-to-day recurring activities. So, here we are not considering these differentiations or these assortments within these groups, so called current asset and current liabilities. So, it is rather advisable to accommodate all these things in advanced level of studies if one would like to have a better orientation of working capital calculation after calculating all the current assets and current liabilities by using weights on a subjective orientation, considering the speed with which assets are getting converted into cash and the level of urgency with which the liabilities are expected to be repaid. Now, in this first step, we are required to calculate working capital, and as the fundamental data requirement of funds flow analysis is at least 2 years financial statement. So, we are going to have access to 2 years balance sheet, and in 2 years balance sheet we are going to have bunch of current assets and current liabilities which are getting disclosed in the balance sheet. Now, for the calculation of working capital and its changes, we are there to make use of a format which is falling under the ambit of the statement of changes in working capital, which is essentially comprises of 7 different columns starting with particular, then the original information which are retrieved from the balance sheet pertaining to the oldest year or the previous year technically leveled, followed by the current year's information which are extracted from the balance sheet. Then the fourth column represents individual increase in either current assets or current liabilities. The fifth column discloses the decrease pertaining to individual current assets and current liabilities. Subsequently, the last 2 columns are going to talk about the changes in working capital consequent upon changes in any of the individual components of current assets and current liabilities. So, this is a typical format which is prescribed, and as I made a mention in the lecture 1 while we are talking about introduction to funds flow analysis, when it was introduced by ICAI way back, it was governed by Accounting Standard 3, but with the introduction of cash flow statement as a replacement to funds flow analysis, this particular Accounting Standard 3 is now known as Accounting Standard 3 revised, and it is catering to the cash flow analysis and its preparation. Now, for the calculation of changes in working capital, we are there to start with current assets. We are there to make a mention like over here when you are going to talk about the individual components, we are going to see to inventory, like here hypothetical example is there in this slide, that is inventory, it is 15,000 and in the current year it is 20,000. So, individual increase in current asset is 5,000, and the logic is that when we are preparing schedule of changes in working capital, we are creating relationship between current asset and working capital on the other hand. Similarly, we are establishing relationship between current liability and working capital on the other hand. The relationship between current asset and working capital changes are direct. So, for example, if current asset increases, obviously the working capital is going to increase. If current asset decreases, the working capital is going to decrease. But on the contrary, when you are going to talk about current liabilities, there exists an inverse relationship between current liability and working capital. If current liability increases, working capital will tend to decrease. If current liability decreases, working capital would tend to increase. So, we are using these two fundamental relationships while preparing schedule of changes in working capital as disclosed in this hypothetical example. Let us say inventory, just I made a mention of. In the previous year it was 15,000 and in the current year it was 20,000, increase is 5,000. So, as because there is an increase in a component of current asset, the same is made a mention in the increase in working capital column. Similarly, if we are going to take the next item debtor, it is 32,500 and it is 27,000 in the current year. So, it appears that there is a decline in the amount of debtor from previous to current year by 5,500. So, it is shown in the individual decrease column 5,500, and as there exhibits a direct relationship between current asset and working capital, it is also shown in the decrease in working capital column 5,500. After mentioning all the current assets one after another, we are there to make the total of current assets. Then we are there to make a mention of all the current liabilities as it is depicted in the format like creditors. It is 22,000 over here and 23,500 in the current year. So, it appears that there is an increase in working capital from previous to current year by rupees 1,500. So, it is shown in the individual items increase column 1,500. But owing to the inverse relationship between current liability and working capital, when the component of current liability increases, it is going to have a negative impact on working capital and it leads to a decrease in working capital as it appears in the decrease in working capital column, that is 1,500. So, in the same manner, we are there to make the treatment of all the individual current liabilities in terms of increase and decrease and its subsequent impact on the working capital. Then we are there to make the total of current liabilities as it is made over here. For previous year it is 37,000 and for current year it is 33,500. Then as we all know, the working capital is the difference between the sum total of current assets and sum total of current liabilities. Here in the format it is calculated. For previous year it is 10,500, for current year it is 13,500. It appears that there is an increase by 3,000 so far as the working capital and its use is concerned during these two balance sheet dates. Now, the same is made a mention in the format under the increase oblique decrease in working capital and the totaling is equalized. Coming back to the last two columns where increase and decrease in working capital is mentioned, here we are there to make the sum total of all the increases in working capital, it is coming to 10,000 and we are there to make the sum total of all the decreases in working capital, it appears 5,500 plus 1,500, that is 7,000. So, the total increase in working capital is 10,000 and the total decrease is 7,000. So, it appears that there is a net increase in working capital when you are going to offset the increases and decreases in working capital, which is mentioned as a balancing item in the decrease in working capital column in order to make all the two columns equal. So, this is a simple example to explain the modus of calculating the working capital and changes thereof between two balance sheet dates as part and parcel to the preparation of funds flow statement within the ambit of funds flow analysis. So it is essential and it exhibits the changes in the requirement of floating capital or circulating capital to meet the short-term obligations of a business organization during a particular financial year. Now, down the line when you are going to discuss the funds flow statement, we are there to consider increase in working capital as different to that of decrease in working capital, because when we are talking about increase in working capital, we are there to apply additional capital in the form of resources. That is why it is called application of fund as shown in the funds flow statement. On the contrary, when you are going to talk about decrease in working capital, we are able to perform all these recurring activities in the best and most efficient way, and as a consequence we are able to reduce the use of floating or circulating capital. So it is otherwise interpreted as a source of fund. Now in this lecture we have mostly covered the schedule of changes in working capital preparation and discussed different components of current assets, current liabilities, and the relationship between current asset and current liabilities with that of the working capital, and the impact of individual changes in current assets and current liabilities with regard to working capital and its changes. Having mentioned all these things, obviously as I said, this is the first step in the preparation of funds flow analysis. We will be dealing with subsequent steps in the subsequent lectures to have a holistic knowledge and understanding about funds flow analysis. Thank you, thanks a lot for your patience.